Welcome to the Financial Armor Show. My name is Brad Cooper, CEO of Cooper Financial Investments. So, as always, I want to welcome my co-host, Tony Shore. How are you doing today, Tony?
Oh, I am so great. As I often say, if I was any better, my name would be Brad Cooper.
Boy, you would be doing good.
Right? Right? I've had a great week, got away a little bit last week with the family and
Yes.
experienced some of your desert heat out there. That was fun. But you know what? It was
Yes.
so hot back here in Minnesota that the humidity, it was 90 and humid. I'll take 100 and dry heat
I would
any
too.
day over 90 and 80 to 90% humidity. It was because you walk outside and you're just
Right.
wet, right? And it's harder to breathe. But yeah, it got a little warm while we were out there, but not too bad. Hit the pool hard.
Oh, how
So yeah.
fun. Well, I don't miss that humidity being from Missouri, but I just looked at the forecast. So thank God you two aren't in Arizona this week. I think by Wednesday or Thursday, 117 is the
Ouch.
high.
Yeah.
So, but you know what they call it? It's a dry heat, right?
Yeah. At 117, it's like, but an oven is also a dry heat,
That's
Brad.
right. And
The
that's
ins-
what it's like. Put your oven up to about 500 degrees. 30 minutes later, open the door, put your head inside, and that's what 117 degree feels like in
Oh
Arizona.
no, no.
But but we do what you do in Minnesota and Becky as well as in Kentucky when it's cold and snowy and you just stay inside.
Yeah.
Thank God for air conditioning.
Yeah. Well, I don't know how you did it, but we have an amazing special guest for the show. What a huge get. Brad, you pull the strings, you get the big names. Tell us about our special guest on the show today.
And I will. I'm so excited. Within the past week, two of the greatest things has happened probably in years. And number one, well, I would say number two, Becky. Let me go to number one. I have my first grandchild, a grandson, Beckett Daniel Tran. So I am a proud grandpa. So that was the highlight. Then I believe the next day I was visiting with Becky, who's our guest, which I'm going to introduce, and have her on our podcast and talk about the wonderful, beautiful, act that just passed in Washington, D.C., which we're going to talk about today. Is just very exciting. But let me just introduce our guest, and I'm just going to look at my notes because I don't want to miss anything. Becky Swansburg, she's the CEO of Stonewood Financial and really the nation's leading expert when it comes to legislative risk, taxes, retirement. She's a nationally recognized public speaker. So finding time to be on this show is such a big honor. She's also the author of several books, The No Compromise Retirement Plan, The New Rules of Retirement Savings, and the New Holistic Retirement book. By the way, if I forget, after this podcast, I have a copy of all the books that Becky has written or co-written. So you can get a copy from us. And also she's her background, which I won't hold this against her. She survived in Washington, D.C. for many years and under the Bush administration, I think. So really what's exciting about Becky, we had her on one other time, but also, to bring in her expertise from Washington, D.C. and know how things work there. Then with all these new tax bills, and I'm sure Becky's going to talk about permanent versus not permanent. And there's a big difference. There's nothing permanent in Washington, D.C.
That's right.
She can bring the two together and really who that impacts. And that is middle-class Americans, the majority, who we are out to help and educate. So Becky, thank you so much for your time today. How are you doing?
Oh, thank you for having me. I'll tell you, we spent last week also on vacation out in South Carolina in Hilton Head Island,
Yes.
where it was not a dry heat. So I too will take the 117, let it feel like an oven. Just let me breathe in some air that
You're
isn't
right.
an affront to my lungs.
Well, good. So let's just address for the next few minutes we have on this show, the one big beautiful bill act that just passed in the last 30 days, and maybe touch on some of the highlights. I know you've been talking for the last month, probably every day, probably all talked out on this topic. And but maybe touching on the important components that's going to impact our listeners, whether you're
Absolutely.
retired or you're looking at retiring in the years to come, which is always exciting to do. And it's like we're always maneuvering, aren't we, Becky, as far as what, has passed now, what do we need to, work around to make sure that our clients are going to pay the least amount of taxes in the years to come.
Yeah. Speaking of humidity, they call Washington the swamp for a reason. Hot and humid.
That's right.
There's always something lurking in the water there.
Sure.
So obviously
right.
we've had a pretty big summer coming out of Washington. 4th of July, as we were all celebrating the nation's independence, President Trump signed into law the One Big Beautiful Bill. And I will say for our listeners, lots of provisions in this bill that will impact individual people, but I'm finding 3 provisions are really impacting a lot of people. First is we have a permanent extension of these lower income tax bracket rates that were originally passed in 2017 as part of the Tax Cuts and Jobs Act. Those are those Trump tax cuts that during the president's first term, we have these rates at this low level. Actually, today for middle-class Americans, their tax bracket rates are about 30% lower than they were pre-reform. So it's pretty big impact. Those were set to expire at the end of this year. Now they do not expire. They are, air quotes, permanent. And we'll talk a little bit about what permanent means in Washington.
Yeah.
It is not quite the permanent that you and I talk about in our day-to-day lives. Second big one that will impact people, particularly with large estates or with businesses, farms, things that they are passing on, is the estate tax exemptions are now permanently, again with quotation marks, extended at the higher levels that were part of that Tax Cuts and Jobs Act. The third piece is probably the piece I'm hearing the most about, but also has the most confusion. And that is this new deduction available for Americans age 65 plus. And the idea behind this deduction is it is intended to offset the taxes that seniors pay on their Social Security benefit. Now, for a variety of reasons, Congress could not really come in and just eliminate the taxation of Social Security benefits. That's primarily because they had to get this bill past the Senate, and they were doing so under a process called reconciliation, which just is a certain way that some bills can pass the Senate with just a majority rather than a supermajority. So I think what's confusing about this is the promise was no taxes on your Social Security benefit. What was delivered was a tax standard deduction, a tax deduction in addition to the standard deduction for seniors age 65 plus. You do the mental math. In your head, you can say this is offsetting my Social Security taxes. You can say it's offsetting my income taxes. But it is an extra $6,000 per individual, so $12,000 per couple deduction on top of your standard deduction. You can take it if you itemize. You can take it if you take standard deduction. All you got to do is be at least 65 at some point during the tax year. So if you have your 65th birthday before December 31st, you're good, and you can take this new deduction. Now, it does have some limits of income where it starts to fade out. So the full deduction is available up to $75,000 of modified adjusted gross income for an individual, $150,000 for a couple. And then it phases out slowly up until about $175,000 of income for an individual and $250,000 for a couple. So a lot of listeners are going to get at least all or part of this new deduction.
Wow.
Now, this one is not permanent. We only have this one for 4 years. So it's only good for 2025, 26, 27, and 28 tax year. It is gone in 2029. So it'll be a great benefit for seniors for the next couple years. And it's certainly something to be excited about.
So with that said, Becky, I've had this question probably twice in the past week, as we're talking about this, deduction of $12,000 per couple and the income restrictions. So they said, well, Brad, if that's the case, we should probably limit or eliminate any Roth conversions in the future. So what would be your take on that, and I'll tell you kind of, what I advise thereafter. But because if you go over a certain amount of income, you may lose that benefit, correct? And then another issue we got to look at, which we always do, is IRMAA, the Medicare adjustment, premiums.
Yeah. So, your clients, like the people I'm talking to, number one question, do we need Roth conversions anymore? Hey, Congress just made these tax cuts permanent. We have this new deduction. Taxes are great, and they're going to be great forever. Of course, nothing in Washington is forever. And when we talk about the permanent extension of these tax cuts, what that primarily means is that they will not automatically go away, which means tax bracket rates will not automatically adjust to their older, higher rates. At any point, Congress can come in and change them. So if we look at low tax rate eras going back to the Reagan administration and the cuts some of our listeners might remember from the 80s, most of those last between about 6 and 12 years that we're in a lower tax environment. So the Roth question is a good one because right now we are in a very low tax environment. The challenge is there are really two pieces of a Roth conversion. And I've been saying one big, beautiful bill has not eliminated the need for Roths. It's actually enhanced it. But what it has eliminated is the ability to successfully optimize Roths on our own because they've gotten more complicated. And you really got to work with a financial professional that understands all these moving pieces. So here's what we have. One piece of a Roth is deciding, what do long-term taxes look like in retirement for me? And are there tax savings through a conversion? Now, if one of our listeners said to me, Becky, I only want to be retired for the next 4 years, I would say, okay, the only thing we have to worry about is today's tax environment. But most of us, of course, plan to be retired 10, 20, 30, even 40 years in the future.
Right.
Long-term, the tax outlook for the nation has not changed. And I'll tell you, there are 3 indicators that I constantly watch when I'm trying to look at the long-term tax outlook for America. Those 3 indicators. Number 1, are we paying for the government we currently have? Now, in the last fiscal year, our government took in about $4.1 trillion, and we spent about that exact same amount on Medicare, Social Security, and debt service alone.
Just those 3 items.
Just those 3.
Yeah.
So every dollar the government took in was spent before Congress and the president even passed a single bill. Wow. So that is how every year we're running a $1.5 trillion, $2 trillion deficit. So even today, we cannot pay for the government we have. The second indicator I watch is demographics. We have a rapidly aging population in America. And in fact, that we are going to have more seniors age 65 plus than at any time in the last 100 years. What that means is that Social Security and Medicare, the 2 primary drivers of government spending, are going to just require more and more money. And it's not long-term. They expect by 2034, 10 years from now, that Social Security will only have enough money to pay out about 75% of benefits unless taxes are raised. So first we're not paying for the government we have. Second is our demographics are making the problem worse. Mm-hmm. And the third indicator I look at are what I call debts and deficits. We currently have about a $36 trillion federal debt. I mean, Brad, is higher than at any point in U.S. history. When you add Social Security and Medicare unfunded liabilities to that, that's about another $75 trillion with a T over the next 75 years. So long-term outlook on taxes, our government is still desperately in need of new revenue. What One Big Beautiful Bill has done is given us an opportunity to make some adjustments to prepare for those rising taxes today at a lower rate. So what has really changed about One Big Beautiful Bill is we've got to find the common ground between leveraging and fully taking advantage of these low tax bracket rates while not unnecessarily giving up that new deduction for seniors age 65 plus. Right. And what I've found, and I'm curious if you found this with your clients as well, is that a conversion that we might wanted to rush all into 2 or 3 or 4 years in the past, now we might want to spread out 6, 8 years to convert those funds a little slower so that in any one given year, we're not boosting too much income and sacrificing some of that new deduction. But long-term, taxes are going up. And short-term, we have this huge gift that One Big Beautiful Bill has given us to be able to take advantage of lower tax bracket rates for a lot longer into the future.
So well put. And this is the conversations we're having on a daily basis. And, and one thing that, I want to brag on you as being CEO of Stonewood Financial and the support that we get, the technology platform that you have put together for reports. And by the way, if I forget, all the listeners, if you want a personalized tax analysis report that's going to be personalized for you, that takes in all these factors that Becky just talked about, reach out to us and we can personalize that report for you because, every person that comes to our office, Becky, it's different. I just met here in the last couple of weeks with a very high net worth, person. And we get on the topic of taxes. And of course, they get it. They believe taxes will increase and there's a need, but also another big factor, which we don't talk enough about, which is not an issue now for most Americans, unless your name's Tony Shore, is the estate tax exemption, where as a couple, you got to be worth more than $27 million for it to impact, correct?
Yeah. Yeah.
But that exemption may come down. And most likely, from our conversations, will come down in the years to come. So that has a big impact on further taxes, which is called estate taxes, in addition to federal income taxes.
Yeah. And then you mentioned in passing, one of the biggest indicators, I think, of where taxes are heading, and that is IRMAA. Right. So for listeners that don't know, IRMAA is the Income-Related Monthly Adjustment Amount, a great government acronym. And it is simply
Aunt Irma. That's
right,
the mean. That's the mean aunt, though.
Yeah. You may not know this. When I was in Congress, one of my specialties was when I worked for Congress was actually creating bill names that could have snazzy acronyms that go with them.
So you were responsible for IRMAA?
No, I did not do IRMAA, but I had some good ones.
You weren't responsible for the Inflation Reduction Act that did nothing to reduce inflation, did you? Because I love it when the bill has a name that's exactly the opposite of what it accomplished.
Right.
Like when the Inflation Reduction
Call that whatever you want. I'm going to call it the Everyone Named Becky is a Wonderful Person bill.
That's right.
And it raises taxes on all Americans. All right. So IRMAA. This is why I think IRMAA is important to understand. IRMAA is an additional fee or tax that some savers pay on top of their Medicare Part B and Part D premiums. So based on your income level from previous years, the government says, hey, actually, you not only owe your premiums, you owe additional fees on top of it. Now, why do I think that this is so important? Well, when we think about taxes in retirement, a lot of times we think about tax bracket rates, and we kind of let that be a stand-in for our tax burden in retirement. But there are a lot of different ways that Congress can actually change our taxes. Right. So they can change brackets. They can also change the amount of income applicable to each bracket. And that was a key piece of Reagan's, I think it's 86 tax return, where they brought down that TOPS tax rate. And the way they got agreement over that is saying, but look, we'll apply a lot more people to that tax rate. Third is they can change and adjust deductions, and we've seen that. But the fourth is they can just get creative with some new taxes. And I know IRMAA is technically a surcharge, but IRMAA is money that the government takes from you to go in its coffers. I like to call that a tax. Here's why I think IRMAA is so important for us to understand. Every year, the Medicare and Medicaid trustees come out with this report where they look at the fiscal health of all the different government health trust funds. And in the most recent report from last year, like Medicare Part A, the hospital coverage, trust fund in dire shape. Right. It is expected to run out of money in the next 10 years. And most of the trust funds are like that. They have this dire outlook where they don't have enough money. There are two shining exceptions to that. And that is the Medicare Part B trust funds and the Medicare Part D trust fund. And the report says that these trust funds are totally fiscally stable for the next 10 years and beyond. So it sounds like great news. But before we all go and celebrate, there has to be a catch.
Right.
The reason the government says these trust funds are stable is because they can raise Medicare premiums and IRMAA surcharges as high as they need to meet trust fund shortfalls. So they're essentially saying, hey, we can just keep every year raising this tax. It doesn't take legislation to change. It is established or just declared by the department what these fees will be. And we can just keep raising them every year as much as we want to match up those shortfalls. And to be fair, that's what they've done since 2019 for the lowest IRMAA bracket tier. Prices or that fee has raised about 7% a year, compounded year after year after year. So that IR and IRMAA, that income related, I think is going to be a trend that we see into the future, which is what else can the government do to generate more revenues and more fees tied to the kind of income you're reporting. And that's where Roth conversions, I think long term, will continue to be so important. Because do you know what is not considered for your IRMAA calculation? Income from Roth accounts or other tax-free vehicles. So the more that we can diversify the tax status of our retirement assets and have some of those tax-free assets, we're not just protected against rising taxes in the future, but also from these extra fees and surcharges and whatever they decide to call them.
It just reminds me here, about a year ago, I was on a training call with you, Becky, and you mentioned, when Congress is throwing out, this is only going to be for the rich, this tax increase. If you make $400,000 or more, you will be impacted. If you make less, you won't be. But I'll clearly remember you saying this is a way that the IRS, that Congress is going through the back door and taxing middle-class Americans. And in my lifetime, even though I'm only 35 years old, I've seen, middle-class, Americans paying the brunt of income taxes. And that's what's so exciting for our practice with the help of you and your leadership with Stonewood is basically the education process. 67% of our clients, I just calculated this about a week ago, of our clients in the next 5 years will be in a 0% tax bracket. Thanks to the education leadership of you, Becky, Stonewood, and also Ed Slott, which I know you're very familiar with. So that's an area which...
Well, thanks to your hard work helping getting them there. I mean, it is big. I think taxes are the largest, least understood retirement risk facing most Americans today. And you're right. A lot of savers are really surprised to find that when Congress talks about the rich and us only taxing the rich, they mean us. They mean people that have worked hard, had good careers, saved well for the future.
Yeah. Well, it's one thing I like about that extra $6,000 bonus standard deduction is that really does impact the middle class. You can't say that's just for the rich because it phases out at 175. And I actually did the calculations, Brad and Becky, and that's on top of the $1,600 per person bonus already that 65 and older get.
Right.
So if you look at the $30,000 standard deduction for couples, the $1,600 per person, if you're a couple over the age of 65, both of you each get $1,600, then you each get $6,000. That's $45,500 in a standard deduction for the next 4 years. That'll put a lot of people in a 0% tax bracket that are in retirement. And if it doesn't, that'll at least probably bring them down so they, like you said, don't have to pay taxes on Social Security. I just wanted to go back to that because I thought that was, in my opinion, the biggest part of this whole bill.
Well, and I think the important thing to remember is I feel like the One Big Beautiful Bill has given us this huge opportunity, but I know it's complex. And, we hear from savers all the time, what should I do about this? the time is right to work with a financial professional who understands this. And Brad, I love hearing the work you guys are doing with your clients, because now if you are approaching retirement or in retirement, there's a lot that all has to fit together like this puzzle to make sure that we don't give the government more than its share, that we don't not just overpay in taxes, but overpay in IRMAA too. It's all these moving pieces. And, you know, this is one of the few times that I feel the tax code has maybe gotten a little more complex, but really to the benefit of savers if you are working with someone who understands how to structure kind of your approach.
You know, and that's the problem we see in our industry today. You know, 31 years in this industry, the first half of my career, Becky, I was no different
amazing.
than
At
the
age
majority.
35, you started so young.
I know. When I
You
was
were
an
like
infant,
3 years old.
That's right. I was a big achiever.
Boy,
But
genius.
no, what I realized, and I still see it today, and I know you do too, Becky and Tony as well, is the majority of our industry is doing investments and investments only. There's nothing wrong with that. And they're stopping there. They're not addressing all these risks that will have an impact. But let's look at the other side, which I just thought of here within the last couple months. I met with a couple. They just had Social Security checks. They were over 65. So Tony, thank you for the calculation, because I'd have to pick up my phone and do that. So you did that automatically in your mind. 45,000.
Yeah.
To me, that means that they can pull up to about 45,000, correct me if I'm wrong, Becky, out of their IRAs tax-free, therefore allowing their Social Security to be tax-free, or the majority of it.
Mhm.
So then if they're over the age of 70 and a half, I just had this conversation this morning, then qualified charitable distributions on top of that. That's what gets me excited, as far as I'm okay with paying income taxes, but I'm not okay with overpaying.
Yeah.
Right.
It's a great point. And it is, it's an exciting time. It's like,
Yes.
you know, we all think about taxes and retirement in terms of ourselves. Like, hey, how much income do I need? What bracket does that put me in? Or am I filing joint? Or at some point in retirement, do I become a widower and file at a single rate?
True.
But all of those different decisions all exist in this ecosystem from Washington. And we've really been gifted a limited time gift of this lower tax bracket environment to make these adjustments. You know, I like to say, I don't think there is a saver in America, no one listening to this call today, that truly cares about the size of their IRA. What they care about is how much of that IRA money ends up in their bank account to spend.
That's
and
right.
The difference, the delta on that, is taxes. If we overpay in taxes, we undergenerate income. And so I agree. I'm always surprised that people put so much of their passion and attention into the market and how we're growing and protecting these funds. But they forget that there's this silent partner in that account, you know, that's the IRS that's going to come in and
A joint
snatch some of
account
that
with
away.
Uncle Sam. It's a
Yeah.
joint account with Uncle Sam, and I don't even think he's my real uncle. So I don't even want him.
And the problem is he makes the rules. We don't. On
Yeah.
what percentage he needs to keep. So,
Yeah, that's
wow.
bad.
Time has gone by so fast on this call. You know, we were just talking about the heat earlier. I'm going to have you, Becky, come out to sunny Arizona when it's like 65 and sunny and not hot, and speak to our clients, which I'm really excited to do in the next year. But before we end, I talked about a tax analysis report that we personalize through, you know, the help of Stonewood, Becky's company, and what they have developed, which talks about not only tax savings, but also IRMAA, which that's a new feature they just upgraded. The report is very, very, you know, important to see what taxes will, you know, be and how they can impact you. So, but as we close today, thank you, Becky, so much for your time that you carved out to be on the recording. And if you want more information about this report or any of the books that Becky has co-written and published, contact our office. You can call us at 888-390-5277. Again, that's 888-390-5277, or go to financialarmorshow.com and send us a message, and we will reach out to you and send you a copy of those.
All right. Well, we want to thank Becky Swansburg
Thank you.
of Stonewood. Appreciate having you on the show. That was great. A lot of great
Yes.
information to think about, and you want to have a plan for those taxes. So I encourage our listeners and viewers to give Brad a call, and hopefully we can have Becky back on the show again to talk some more about this. That was great, Becky. Listeners and viewers, that does it for today's episode of the Financial Armor Show with our host, Brad Cooper.
Thank you, Tony.